Good afternoon, everyone. I hope everyone can hear me.
Yes.
Good afternoon, Pratik.
Sir, good afternoon.
Good afternoon. How are you?
Fine, thank you, sir. Kalyan, sir, good afternoon to you too, sir.
Good afternoon, Pratik ji.
Looking forward to your session, sir. 3 दिन हो गए हैं.
Thank you so much. Thank you so much, sir. I should thank Dr. Rakesh for this opportunity.
Very, very true, sir. He's the point behind the entire development, sir.
Ji.
No.
Last time we met in Kathmandu.
Yes,
It's been
sir.
a long time, sir.
Absolutely, sir. Absolutely. It's been quite some time.
In
So
fact,
we will just
we were
start.
talking about.
We will just start the session in few minutes.
Yeah.
I hope everyone can see my screen.
Yes.
So before we start the today's session, just to give a brief background of our association. So maybe most of people are our members only, but still there may be some new people who would be joining. So for them, just a brief overview about our association. So basically, our RMAI is a global body on risk management, research and development. So it was founded in the year 1992. So basically, our objective is to promote education research in the field of risk management. So we do organize webinars regularly on risk management and various topics. And we have been doing this since last few years. And we also have launched a course on risk management. So basically, our activities include this online course, seminars, workshops, then awareness initiatives through various channels, and we publish a quarterly news bulletin too. So there's a list of various webinars we have conducted, list of our partners institutions. So this course RMAI we launched in the year 2021, and this has been we have enrollment from around 7 countries in this course, and this course is doing very good. So again, we brought some course on generative AI and certificate course on risk management in banking, one in motor insurance, reinsurance, health insurance. Is a list of our council members, advisory council members, some of the industry experts who are guiding us. There's a list of few institutions where which have been supporting us: Insurance Times, the monthly journal. Then very recently, we have launched this portal BimaBazaar.com. So in this portal, we cover all latest updates about the insurance industry. So apart from news, it covers interviews from stakeholders, news desk, then case studies, and it is a repository of the Insurance Times journal for last 5 years, and we keep on adding the old issues in our repository. So it was just a brief introduction. So before we start the session, let me just briefly introduce Mr. Sridhar. So Mr. Sridhar is a veteran from banking and financial services industry with over 44 years in the field, having started his career as a PO with SBI in 1980. He focuses on risk and resilience management consulting and has clients not only from BFSI industry but also across varied industries, including manufacturing, liquid bulk storage, telecom, and all. He also coaches both individuals and organizations with prep training for acclaimed certificate examination of ICASA, USA, ISC2, and other exams. So now I'd like to invite Mr. Sridhar for rest of his introduction. It would be quite big. So you can just introduce and then I will share your presentation also.
Thank you, sir.
Yes, sir.
Thank you, Dr. Rakesh. Thank you, Risk Management Association, for this lovely opportunity. Just as a I'm very generous with this uh, introduction. Coming from the banking industry with about 40 years, the most important thing is we are not stopped keeping in touch with the industry, not only from a consulting perspective, but also in terms of finding out, for all the time trying to learn what is the development that is happening as we were doing when we were on the service side, that is when we are working side of the industry. And one such recent conversation with the younger generation of risk managers, particularly from the banking side, brought us to a very interesting development that has been happening. In fact, as we will see in our presentation, it only confirmed our trend analysis of a trend of where the regulators, particularly governing this financial services industry, both Reserve Bank of India and the SEBI, as it were. Of course, we also have IRDAI, which covers the insurance side of industry, but SEBI being more of a overlapping, all types of industry sort of a cover. So there, one recent development was where about probably at the beginning of this month, I'm not exactly sure of the exact dates, one organized one attempt to bring together the senior risk officers, the chief risk officers, ranging from executive directors on the board, representing the risk management function of a bank, to very large NBFCs that we know, which are almost all the top 10 of them are larger than many of the banks, not just some of the banks, many of the banks in industry. So they are by and large banks themselves. So you can say in the entire financial industry, the the large organizations were certainly represented, because it was a very widely distributed crowd of about 45 participants were invited for a seminar that was held by the CAFROL, the College of Agriculture and in Banking, Pune, an arm of the RBI, as most of you would know. And there, the focus of that discussion was on, how artificial intelligence today, which has permeated into almost every single requirement, is going to impact or, is already impacting the risk management, initiatives, risk management practices, risk management projects that were to come of the industry. And therefore, what would be the challenges, what would be the benefits, what would be the common, thought processes. So when this was discussed, then I immediately, when we were discussing, Dr. Rakesh immediately said, why don't we very quickly get the rest of the people who are not on that particular CAFROL CAB meeting. And so let us hold from the Risk Management Association, the RMAI side, why don't we hold a webinar? So I thank him for that opportunity, and RMAI made this possible. So it is my pleasure to share a little bit of my learning on this. Why I say a little bit of it, it is just not modesty. AI, I have been speaking to some people who are considered experts in that subject, and they tell me that they are, probably they have started well. So guys like me, most of us possibly, when we look at experts like that, then I think it goes back to our poets and others who said, what we learned is only a handful of sand, in a seashore and all that stuff. So from that perspective, I present to you a few thoughts that I think will probably ignite further discussion. Definitely is designed to bring a greater degree of curiosity in all of you, and from simply a platform of where I, like Rakesh ji said, probably an avuncular position in the industry, having put in 45 years, 44 years here, would very strongly advocate all of you to pursue the pursuit of knowledge, particularly pursuit of knowledge in general and in AI/ML related terms in particular. AI is going to help a lot of jobs. There are a lot of fears on whether jobs will be lost because of AI ML. But to quote a very senior scientist from IBM, jobs will not be lost because of AI ML, but job seekers will lose an opportunity if they do not know AI ML. So he put it like that. So I'm paraphrasing him. And I think that's a very important uh, direction for us to keep in mind when we look at whether it's a threat to our job or is it whether threat to our capability. They are two different things. So therefore, now, for example, a retired guy like me, there is no threat to my job because I don't have a job. But is there a threat to my capability? Oh, yes, it certainly it is. If I think, okay, I have retired, I'm not going to, what is I going to do with learning about AI, ML? Then I'll be left behind. I will not be fit for purpose. Even if, let's say, very senior professors like Professor Priyadarshi here and others are talking about it, I wouldn't be able to make any sense of it. So it is left to us to build up our capabilities so that we are able to perform whatever jobs we are doing in the relevant way, in a better way. So with this small preamble, I would request that we go into the presentation itself. We have a presentation to give us a background for discussion. Sir, should I present it from my end? Yeah, all right. Kindly give me a minute. Yeah. Can Dr. Priyadarshi, can you see my screen, sir?
Yeah, we can.
Sir, it is visible.
Yeah, thank you. Only thing I'm having a challenge is, in fact, two challenges. One is I'm losing visibility of our Zoom screen. So therefore, anybody wants to ask a query, it has to be an audio queue. So if you simply post it in the chat box, unless I come back to the Zoom screen, I would not be able to read your, query or question on the chat. So therefore, you should kindly give me that, give me saying, or you want to raise anything, just say, listen, I want to stop you for a minute. So that is all right. Second thing is, if we are on the, when we are presenting it from the presenter side, sometimes the slideshow doesn't work. Therefore, the animations that we thought, may not really happen the way it is happening. So that also probably will have to be kept in mind. So welcome again, very formally, to the regulatory expectations. What we understood over looking at what's been developing, I should say, if you step back a little bit, as we will see in a couple of presentation slides, if you step back, if we go back to November 2023, where IT GRC guidelines were mandatory through a master direction of the RBI. Now, while this was seen as more of a consolidation of various initiatives, including updation of probably our Bible, the Gopalakrishna Committee recommendations, and so on and so forth, what as it transpired was that the regulators were actually setting a platform that would evolve from that point into something completely, which will become completely contextual in what is happening in the general commercial world around us. In fact, the word commercial is more to bring in focus our work, but it is even in our personal lives. We see the effect of artificial intelligence and machine learning. Either we ourselves are contributing to it, or generally most of us, 99% of us, use the developments, are beneficiaries of the developments that are happening in this field. And to cap it all, I'm going to now jump straight away from November 23 to, a week back, in October 24. A week back, what happened with the Nobel Prize Committee, awarding the Nobel Prize to two physics professors for their work on artificial intelligence. Now, this is, I'm certain, definitely could not have been a part of the overall regulatory, firmament. That means in India, the RBI, the SEBI, the IRDA, all the good regulators, while they are working on a particular pattern of introducing certain developments, certain requirements, certain expectations of us, which will culminate into a state which would be the desired state, right? On the other hand, the Nobel Prize Committee declaring that artificial intelligence, be the focus of their awarding the highest award in science, particularly for physics. Now let's see where is the connection between these two dots. And this is where it is probably the lack of animation is going to help. If you see on the left-hand side of the screen, we will see John Hopfield and Professor John Hopfield and Professor Jeffrey Hinton. And below that, the NVIDIA graphics card. Now, if you go to the last box on the right-hand side, all of us know NVIDIA's rise. They are the second largest company today in terms of whatever market valuation, revenue generation. They are even overtaken Microsoft. They are just behind Apple. All of us know these statistics. We are all very interested to read these sort of tidbits, and so on and so forth, right? And what projected them to this level, right? It's like as if the last 10 years nobody knew about this company, and to all of us suddenly, these guys are there, probably knocking at the door of number one. And that single product or single contribution came from GPU. So GPU, probably it is worth talking about what GPUs. So as you can see, electronic circuit capable of rendering graphics. And this was mainly developed because of the tremendous growth in the gaming market, right? And the type of hardware, the type of software requirements for gaming, making it more and more almost real life situations and capable of doing multiple choices, multiple functions, so on and so forth. We can go into that as a separate subject. But that it also threw in what we see sometimes, as we say in manufacturing, the value of the, waste is higher than the value of the product, particularly in the plastic industry, the nuclear industry. These are industries where the waste in the manufacturing product, or what we call the manufacturing waste that happens, is actually a higher value. And that's exactly what happened. It is not so much to say into the waste, but what happened was, while GPUs were developed, or seemingly they were developed for the gaming industry, somebody stumbled on, that somebody was Jeffrey Hinton, as you can see, stumbled on the ability to use GPU for artificial intelligence. So this Professor Hinton, actually as long back as 2009, that is 15 years back, nothing with 2023 or today as we speak in October 24. 15 years back, he and his team of students, were able to develop the critical contribute called ANN, Artificial Neural Network. And that's probably why it is called artificial intelligence. As an aside, normally most of us say, artificial intelligence, no match for natural stupidity. From that sense, it becomes more of a biological marker. But honestly, what was artificial about is the development of the neural network, which was biological actually. So that is where probably this came into a physics domain. As you can see, neural networks are basically, based on three principles of physics. The biophysics, which normally deals with how our brains work, and stuff like that. Then the statistical physics, which is a great deal of combination between mathematical and physical, equations that tell you how a statistical process, a data processing happens. And finally, the computational physics, how exactly a computer solves a complex, non-linear or whatever, further, stuff, because that's not our focus area of discussion. So we will just keep it as a reference point, right? I also given you the URL for where you can read more about it. Actually, this is even a summary. The URL takes you to a lovely summary, right? And that particular source has a whole lot of bibliological, references that can take you to further deeper study as per your interest, your capability, your time, whatever is the allowance you have, right? So we know from a contextual situation, it is not as if suddenly the regulators woke up in 2023 and said, hey boss, by the time we come to October, we need to have these 45 gentlemen, ladies and gentlemen, sitting together in CAFRAL and looking at how artificial intelligence is impacting the risk management, particularly in financial services. So you can see these markers, these dots that we are connecting are actually widespread over a very long period of time, right? So without wasting more time on what the background is, let us go into the actual show. So what did Professor Hopefield do? He also brought in they work together along with Mr. Hinton, which without that work probably we would not have AI models that we have today, right? AI itself is nothing new, from a very simple enabler of even spell check and all that. AI has been in various forms, available in various ways. Most of us have been consuming those sort of applications without even realizing whether they are, intelligence, artificial intelligence, whether they are enablers, or even simply a feature of a application called Microsoft Word or something like that, right? So without any of those perceptional classification and categorization, we have looked at it more from a utilization perspective, right? So what we have as artificial intelligence today is possibly, or at least the Nobel Prize Committee feels is certainly an outcome of the work done very heavily by Hopfield and Hinton, using most of the artifacts that were developed commercially by various commercial organizations, including NVIDIA, for their own commercial business strategies. Which brings us to this webinar. What regulatory expectations are. So when you are looking at, earlier Nobel Prizes were for discovery and, bringing in a concept or putting together a concept that didn't exist. Today, as we see, right, even from the LED, where the light emitting diodes were already existing. But as we saw, the latest Nobel Prize that went to the LED field was where white light was created, right? Earlier, we only had red and, blue, right? So when white light was created, it was found to be a remarkable discovery that will, and we know in the application what has happened to general, lighting and, all the utilizations and the, saving of power. And on one side, you had better luminex value or whatever the technical term is. On the other hand, you had a tremendous drop in power consumption. So if you look at benefit to the mankind, if you look at the benefit that is created by a particular applied research, a research on applications that already existed, today that seems to be more in that trend. And the recent the Nobel Prize for the physics discovery is seemingly a continuation of that trend. And therefore, how do we now bring it contextually to this webinar? What are the regulators' expectations? I don't think the regulator, anyway, as we'll see, is expecting you and me or any other player in the industry to suddenly become a Professor Hopfield, or a Hinton. But definitely to explore their thought processes to see whether we can use existing, technology, existing applications to see whether we can enhance value in our risk management. With that preamble, let's go ahead. Again, just recalling what happened. I spoke about the November 23 IT GRC, master direction. Then in April 24, it was followed by the ORMF, the operational risk and operational resilience framework. Now you would like to ask what is new about it. The most important part is, till this particular master direction circular came in, there was no requirement for any organization, particularly in the banking industry, to set aside regulatory capital for the risk faced from their risk and resilience profiles. It was more of a choice and option, and most of them exercise their choice and option more in the ICAP process than in the primary. That means not in your pillar 1 capital requirement management, but more in your pillar 2 and management. So therefore, it was more of a maturity level of an organization that decided what will drive their capital requirement. That is possibly one very, profound impact. But there are other impacts also. One of them was the focus that was brought on the cyber or the technological or the resilience requirement for an organization in a very, very connected world. I always tell when we talk to there are many people here, even in those this thing. I regularly keep conducting classes for various banks when the senior leaders invite me for, for what they think could be useful to the teams. And everywhere I always tell them, when I started my journey in the technological field, there was no risk called cyber risk. Not because we were experts, because we were not connected. Simply because the technology that we were using was completely within our own box. We were not even talking to our head offices, right? And so on and so forth. That being the architecture, even there, the loss of data could happen because you lost the medium that had the data, not because somebody went and were able to, sort of what we call hack into your medium. So therefore, with the changed world between when I went into technology base in the mid 90s, that's about 30 years now, and where we are now, everything is connected. In fact, we have plug and play situation. You don't even know where your data is sitting apart from regulatory data localization requirements and so on and so forth. So from that perspective, the operational risk and resilience management became very important. And the next marker came in fraud risk management, particularly for the large NBFCs. Now, fraud risk management is nothing new. Frauds themselves were nothing new. So they were being managed very well by the top people. In fact, right up to a small NBFC working with less than sub 100 crore what do you call balance sheet size, they were managing their frauds. So what was very important in this circular? The circular brought about a focus on early warning, detection, early warning signals, putting together the data, reporting to law enforcement authorities. So what probably became a standard became on the discipline surrounding what you are already managing, and it now by this circular requirements or the master direction requirements, it became mandatory. Then we went into something in August that was probably the eye opener or told us that our thinking is correct. When RBI came out with the model risk management paper. And this particular paper, if some of you were in the know, when you looked at the paper carefully, what it did was to very, importantly bring home the requirements in what we will see later on as the NIST guidelines that supervised, the artificial intelligence, particularly in data and model risks. And, so how would that come? The risk management framework that came there, what we normally call 101 and 601, circulars, they came in because that came in July, right? And finally, SEBI, which has been, discussing on cyber security and cyber risk framework for almost a year. The consultative paper came in September 2023. The consultations, iterations were open somewhere around March. And, certain developments, the SEBI board had to clear the final version. And after all that, it actually came out in September. And therefore, if you look at the October 24 seminar, was possibly waiting for the overall guidelines or the logical conclusion of that to happen at that marker. So if you want to summarize what we just spoke, this particular slide could be very, very useful to you, right? What are the 5, 6 markers that we have spoken? What is the area of focus? What we think is the intended objective? But anyway, in fact, this is not just our thinking, it is our understanding of what they have actually spelled out as what their objectives are. And the regulated entities' key responsibilities, is summary of possibly what we need to talk further as the expectations of the regulator. So you can see from laying the foundation in, November 23 to, use of AML in model risk management, particularly in August of 24 through the credit risk circular, right? The entire value chain has been very well clearly defined by the regulators. So it is only now the ball is purely in the player's court. That means the various participants' court. We need to now rise up to it. And we hope this seminar will help us in our thought process in that, journey. So what is AML in risk management? Before I go there, I would like to ask if there are any questions from anybody for, before we continue. Hope we'll get a copy of the presentation. Yes, you can address Dr. Rakesh. I'm sure the Risk Management Association team will definitely, any questions? Let me look at the chat box. Okay, it's more on the WhatsApp group and all that. Very good. This is also very great. Though it's a logical platform, we can do logical networking. In a physical platform, you do physical networking. So participations in such webinars, is always very useful. And occasionally, you also get like what I have today, an opportunity to even be the webinar presenter. So probably your thoughts one day we will be learning from that. So now we will go back to our presentation if there are no questions. So what is the use of artificial intelligence and machine learning in risk management? So we will look at some of the basic concepts for more of clarity and setting the tone of a discussion. Because if you go into the literature, the study part of it, the elephant has been described in many different forms and not in a wrong manner. You look at risk management. I have given you the display from Investopedia. What does he say? Investopedia, he says, it is a process of identification, analysis, and acceptance or mitigation of uncertainty in investment decision. The key to this is the investment decision. Why? Because for investment or investment activities, that's Investopedia is an organization that puts together all the thought processes, knowledge levels, everything from an investor, investment practices, investment perspective. So therefore, he is going to view that part of the elephant only from that. There is more to tell you. Now, if you went into probably a bulk storage, industry SRO guideline, it would focus more on what is very immediate in terms of what is called proximity of the relevance to their activities, right? So therefore, just to bring in our common approach for this at least webinar, aspects of risk management are normally from the risk management perspective, which has an identification, analysis, evaluation, and monitoring. Monitoring what? Monitoring whatever you are planning to do, what you have actually implemented, and therefore what you can improve, continuous improvement and all that. So we all go back to the PDCA cycle of Professor Deming and so on and so forth. So basically, this is a recap on the RM risk management processes. So if you look at artificial intelligence looks at how we can, gain benefit through, automating most of the process. So artificial intelligence is not just automation. Automation is one of the methods of, bringing in artificial intelligence into our risk management processes. So for want of a definition again, AI risk management is a systematic process of identifying. So there is absolutely no, let's say, variance till by policy, by design, you go change what you want to change. So therefore, there will be great degree of standardization, at least within an entity, if not within an industry, and so on and so forth, right? Identifying, assessing, and mitigating. Mitigating is basically bringing down the risk to your desired levels, your acceptable levels, your tolerable levels of even existing and potential risks. For why potential risk? Because potential risk, the data that you have to consume, you have to crunch, and you have to make meaning of, is possibly today growing at an alarming rate that unless it is automated, possibly you're more missing out on more than you're consuming the less, right? So potential risks associated with the use and deployment of artificial intelligence technologies. So again, we go back to the same NVIDIA example. Their existing GPU, which they had requested 15 years back in 2009, was found to be more suitable or even as suitable for gaming as it is for artificial intelligence, and so on and so forth. So there is more reading. There is a URL there that will help you understand this better. What is the outcome that can come out of an artificial intelligence? It becomes more efficient because it removes any biases. It removes at least, by design, it helps you remove all the biases and definitely remove the process errors and other input variables that can affect the value of the outcome. It is more accurate from an accuracy point of view, and so on and so forth. And therefore, the strategies predicated on such outputs are better than those that are not. And therefore, the value from artificial intelligence is acknowledged. And which brings us to machine learning, and particularly for credit risk, we use a lot of models by looking at, both internal models that we develop, where you have an IRB methodology that you are, following. Those internal rating models that you have built in are themselves predicated on various, requirements and variables that you have said are the eligibility criteria, right? And then when you look at existing models, what are these models basically structured upon, right? They structured upon ANN, which we spoke about in the beginning, artificial neural networks. Artificial neural networks are, again, as we will see, nothing but, an ability to bring mathematical presentation of like brain situation. That means, most of us know how our brains work from a conceptual way. We may not be able to, explain it. I don't know if there is anybody who can say, neuron N moves from here to there and stuff like that. But we have an idea as to how these guys go pick up information from various things and put it together. And this is the mathematical representation, the ANN development. Then we have random forest and all that. For those of you who want to know what these are, in a very basic way, random forest is a decision tree. Decision tree again uses data, right? From decision trees, we get aggregated data that says if it is in a particular manner or particular value, or if it is not, right? Then the particular type of possibilities or potentials are displayed. I'm just giving you a very simplistic explanation, because our subject is not to discuss the random forest, because that is more of a scientific requirement, which will be a separate subject by itself. So I'm using that limitation that we all use to understand what its basic concept are. So I'm just at a concept level trying to help you with or share with you what I have as an understanding on how random forest is used to look at, where the decision trees, where the distribution of data is used. And when you want to, remove certain, let's say, downsides or limitations of such usage, the use of boosting is done to, bring in together, to optimize the value or the results of random forest, as this paper explains. So again, what is the difference between where you use a normal model and where you use a model with AIML? The process or value chain that is shown in the black circles in the process flow in the top row is your normal model, right? Where you take defaulting data, and non-defaulter data. For both you use the data sets. But when we're traditional credit risk modeling, it looks like predictive insights, and then looks at what is your total loss, expected loss, and stuff like that for whatever you use those models. In AIML, what it can do is it can see whether there is an opportunity, and how is explained in this, but where the artificial neural network based risk modeling looks at whether there are opportunities where you can use. When we were discussing this with certain experts, for my own personal understanding, he gave a very interesting model that I should share. It looked like a little bit of politics, but don't worry about the politics. Just look at the transaction. When Russian oil was, for some blockade, sanction, whatever, right? Now, there was a group of people within the policy making decision, apparatus in India who said, let's, import the crude from Russia that cannot be sold to others and process it here. And that led to an export value, right? Where today the news is, most of you would say, Indian exports of processed crude or processed petroleum or, petroleum linked products, the value of that is even higher than Saudi Arabia, which is a primary or original producer of oil. And India doesn't have any anything comparable to that. And yet, it has gone to a value creation because somebody saw an opportunity in a creation. Now this is probably very high profile, well publicized piece of news. There may be any number of examples like this that we are not aware of, at least I am not aware of. So he said this is the where the data that can be processed, can be used to see whether it can be the same model can be now viewed from a different perspective and then be very quickly subject to its testing. So therefore, the modeling does a different type of clustering, a different type of putting together those markers that were required, and therefore opportunities exist. So from the same original set of data, as you can see in both the streams of model usage, right? The opportunities at the user level, at the risk management level, suddenly becomes not only managing, the type of risks that emerge, but also trying to exploit the opportunities that can be considered. So what are the interventions that can be what we are already seeing that's happening all the time, right? Particularly as we can see, the involvement of technology is almost absolute when we are talking about AIML, right? We can't talk about AIML, without talking about technology or vice versa today, right? So if you look at this particular graphic asset, again, from a normal perspective, information or any technology asset, we would call it PPT. They have gone down. The creators of this particular infographic have gone down to a greater degree of granularity. PPT, we normally say people, process, and technology. So they have gone down. What technology is itself? Hardware, software, data, network, database. If you look at the gray box there, they have data and database as separate assets, which is very, very true. Very, very true. For those of you who are not directly from the technology side, but who are only on the user side of technology, these sort of nuances are very, very important to note and understand what you note. So therefore, these are very good to see. All of this come under, one or more type of threats, right? So therefore, you need to understand what are the threats to each one of them in conjunction with the other, or in totality, in a holistic manner, or a standalone manner, and so on and so forth. So you have straight away a distribution 1 to 1 thread, 1 to n thread, or n to 1 thread, and so on and so forth, right? So these models have to be captured. The threat modeling, threat hunting has to be done. And what is very important is a threat cannot, exploit an asset unless the vulnerability in the asset is very, very large, or the vulnerability in the asset is not mitigated, or the vulnerability in the asset is not protected. Whether it is your borrower in a simple linear lending equation, you have your, portfolio for a particular product, you identify the proper, borrower, you lend the money and complete the value cycle by recovery. 24 months, 48 months, whatever, right? Now, this is a very simple linear equation. Now, what can be the vulnerability? You're identifying the borrower could be wrong. You're identifying the borrower could be right, but your disbursement could be wrong. You're identifying and disbursement could be correct, but the end use could be wrong, and so on and so forth. So for each of these vulnerability, what is the, degree of the vulnerability that will go actually, make the threat of that particular, a transaction going by. Because if the vulnerability is managed, then the threat, though it is there, it becomes more academic. So therefore, we always say, in technology also, most people will understand when I say, vulnerability is a window through the door through which the threat walks in to affect the asset. So vulnerability management. So exploits is one of those. Exploits from a, exploitation done by others who are not authorized to, manipulate something. Then there are exploits that are known exploits for which there are known remediations, rectifications, and there are unknown emerging exploits which are constantly, found, and therefore the patch management and other requirements kick in. The most important thing is, for all of these practices, there are existing practices. In fact, from my manual days, where technology itself was managed manually, to my morphing into more of a, almost automated environment, not fully automated, almost automated environment. We have been managing these things. Zero-day exploits is not something that popped up last year. It has been there from my time of writing my CISA exam, right? So these are not new. What has come as new is in each of these management, today we have artificial intelligence, as a great, what do you call, enabler of making your objective more realistic, your ability to meet your objective, almost certain, as long as your ability to look at your pain point and address that with a suitable tool or process is correct. So therefore, we categorize risk, risk categorization again, right from assessment, mitigation, monitoring, all of those are part of which risk is more important, which vulnerability is more important, and so on and so forth. Your ability to prioritize and stuff, manage the resource, optimize the resources at your command. And so all of this finally have what do you call an output of desired results. So if you look at the key components of risk management today, whatever be the risk management, silo that you're managing. Sir, I manage only, the network. So I don't know about other elements. I've seen people talk like this when I interact at the field level. That's okay. That brings about one good thing and whatever not so good thing. Good thing is he's very focused. He knows his area of operations and areas of limitations. B, whether he is, linked to the overall objective or not, is probably not immediately visible. Should be at least visible at the tactical, if not, certainly not at the, if it is not available at the functional level, it should certainly be visible at the tactical level of managing such resources. So therefore, it is very important to understand how key components of risk management will be managed by AML. So we now need to understand a little bit about artificial intelligence itself. Again, here the animation is missing, but this is a wonderful work. I liked it very much, so I thought I should share with it. There are any number of such resources, so it is not to say that this is the best or something. I liked it very much. Since this is my presentation with Dr. Rakesh's and RMA permission, I was able to present it. You may know something that is better. If you do, please share it with others, right? If you look at AI, right? So what is artificial intelligence? Artificial intelligence, at one level, started encompassing things called machine learning, right? And machine learning, went into a level of, deep learning. And deep learning, today we have generative AI, right? Now, if you look at this cycle, you need to understand what is happening, right? Where if you look at AI at the top of the right-hand side, it took the particular ML, input value. It used a neural network, the algorithms and other things that we have decided what we wanted, what are the variables that will impact, what would be the degree of impact if the conditionality is different, and so on and so forth. The algorithm was built on those things. And therefore, what would be the output value that we'll get. Now, the algorithm building itself, went into the machine learning, or there were preset algorithms for certain requirements, so that it could tell you whether the pattern development is as per your hypothesis or otherwise. And deep learning, even without your input learning, where the machine or the ML process through LLM. Recently I was in a seminar, in a webinar, where that particular gentleman was talking about SLM being better than LLM. For those of you who do not know what is the difference, SLM is small learning model, a large language or large learning models, where very large sets of data are compared. And his argument was, when you compare very large sets of data, or you ask the machine to use such models, there is definitely going to be a possibility of, your dart hitting some target. Now, I don't want some target. I want a specific set of targets. So what should I do? So I should remove the largeness, so that my machine will learn to look at only a specific set of data to achieve my objective. Now, I was very intrigued by that particular line of argument, because whatever I had learned or whatever I had attempted to learn before that was propagating on LLM. The larger the model, in fact, there was this another webinar by TAE in Chennai, where they said larger the model, larger is your, or better is your predictive value, and so on and so forth. And there was this gentleman who was actually on a contrarian subject. Anyway, that being left to experts at that level, it made me think where you help the model by allowing it to look at allowing it to look at any number of databases or a limited set of databases, what it can search. It is like, you are going to Google, to give you an example from what I understood, it is like going to Google and asking Google to do a search for a particular value that you require and also specifying where they can search for it. That means you can say search for only in Stanford, archives. So it becomes small language model. So within Stanford, they want, if there is a archives, if that particular value is available, they would possibly be able to live with value that comes for whatever objective. This is my limited understanding. I checked this up with a few people. They said, you come, we will sit down and learn. So I'm in the process of learning. As I learn, I will come and share it with you as much as I can. But what is very important here is not about me. It's about your curiosity and your ability to learn. Right? So if you look at, you would have heard about predictive model, unstructured models and structured models. Where you have categorized, classified data, then the labels itself could be for what you want, growth, GDP of all nations before COVID. So already there is a label to that data set, and so on and so forth. So therefore, the output itself would be very predictive, right? So your machine learning, what you define or what you require of the machine to what you want of the machine. So generative AI, it uses almost completely unstructured data. One very important point for us to understand here from my learning again is generative AI is supposed to be at least 7 times as power intensive as the normal search engine power requirements. So that is one aspect that we'll have to keep in mind when we talk about our trust, our ability to look at our environmental issues that come in. So generative AI is a great deal, great input value, but if it's going to consume 7 times my power, environment value apart, my operational cost might probably go up. Right? So in summary, this is how it looks. AI, being the start point, today we have come to Gen AI, right? And in this, as you can see in the set theory, right, AI will keep morphing. It will keep developing. It is not as if we have come to a destination. Probably we come to a model. Probably we have come to a plateau. But a plateau normally indicates statistically that there is going to be a movement in the curve. For better, it will go up. If not, it could actually go down back to the, y-axis. So we need to see how things develop. So if you can see, the most important contributors have been the artificial intelligence risk management framework came out of NIST in January 2023. Now this became where all of us, or those of us who are, predicating the use of AI in more and more of our, applications or usages, or our vendors were providing services that depended on the use of artificial intelligence. This became the Bible in most of our corrections of our policies, our plans, our procedures, only for us to find out that as recently as July this year, it came out on the Gen AI risk management framework, which is a layering on top of the 100 one. That in fact, they have, NIST has even cataloged it in under a different sequence, right? So that is 601. These two documents, if you people don't have the rough original copy, please go and download it and find it. Tomorrow is a holiday. I would very strongly recommend it to you for reading. It is very, very useful to understand what they say there, right? So we will quickly try to wrap up the webinar, right? What are our regulatory expectations arising out of this discussion that we have had from our own perspective? Regulators have said a few things beginning from November. We plotted it. So what do we think when we churn it up? What do we think are the expectations? We'll talk about that, right? One very important point everybody will have to understand is data or model poison. Like a system can be hacked just to prove that I can, bypass your access controls and be one up on you, there are many threat actors who would want to go disturb your model, right? Normally, models, we ourselves give our tolerances. The basic statistical principle for any estimation is to have a UCL and an LCL. So therefore, we have a degree of variation to our requirement, but that is under your own control, your own prescription. So therefore, when this happens from an external source, then it could completely toss up your original design. So therefore, this model poison is a major issue that it's not the only issue. It could be one of the major issues that you would have to keep in mind, right? Then vulnerability testing. When we looked at threats to the assets, we looked at vulnerability. And today, vulnerability testing, earlier vulnerability testing, VAPT, most of you are familiar with the term. VAPT, if you did it once in 1 year and showed the report to your management or to your regulators, they were very happy. Why? You are far advanced than those guys who never did that. So from that point of arrival, today where it has become, where any change to the application, any change to the API that you are consuming, the API is not even, you are only consuming the API. IRCTC, the railway booking, portal that all of us consume or allow our customers to consume or, interplay with, straight away generate a debit from there to their account to in our banks and all that. Any change at the IRCTC design by the railway ministry or whatever technology experts they consult, we will have to quickly see what would be the vulnerability that changes create in our systems. And this has to, has made the vulnerability testing itself, so highly focused of so high frequency. Annual frequency is not even like taking a university examination anymore. Annual frequency is long term. Recently, last Friday, in one of the organizations that I, consult with in Bombay, I was telling them 1 year is long term. 1 year is long term. Today, if you're planning for something at the end of the year, possibly you're not planning for it at all. Why? Because at the end of the year, there is no guarantee any of the variables would still be constant to demand such a requirement. So therefore, vulnerability testing has become very important. And as we said in the middle, plug and play. Plug and play has made vendor dependency. Vendor himself is dependent on third, fourth, sometimes invisible layer of party management. All right. My friends in KPMG were telling me, boss, it is no longer fourth, party risk management. It is nth party risk management. We do not know who is the final guy whom we are dependent on for various layers of, the structure that is being put up together. So therefore, how do we look at risks arising of such engagement and the use of artificial intelligence in these applications? So data poisoning, we are given a small, definition in that. There is again further source for you to look at what, most of my sources come from product manufacturers, product or service application developers. And this is very, very useful. I have learned more from product brochures than I have from textbooks. Not to undermine the value of textbook, probably because I'm one of those guys who went into technology from the backside, from the user side, not from, being an MCA or something like that. But in my time and my days, that was the only way. We were thrown into the deep end of the pool without even a life belt called an university education on that. Right? So therefore, we had to quickly improvise. Probably I continue that even after that. So this is a fantastic paper of a vendor on what you can learn about data poisoning. Some of you who might be interested as to which of those vendors, I would personally, probably go to IBM. IBM has got wonderful resources, and most of these resources are free source. You don't have to spend anything except your commitment and time. Right? AI and cybersecurity. You can see the prism. This is again a Gartner infographic. You can see the business value and feasibility are your X and Y axis. Right? So when you look at that particular prism within your overall cybersecurity as a triangle, you have the various value creators. And as you can see, the business value at the LL and at the HH comment has no, reason for you to invest any money there. Take any initiative there. Almost it is empty. At least at the HH, you have 1 and 4 there. 1 and 4, where transaction fraud detecting and abnormal behavioral detection is possibly attributed. But if you see the LL, it is almost vacant. If no need for you to invest anything to take care of your security there, because it requires optimization. Security or risk management, risk mitigation should be on an optimal manner, right? So we have traditional versus AI-based vulnerability testing. Where we have vulnerability testing is a lot of discovery to be done before the actual test. Well, VT itself, there are any number of testing that we can do, as most of us who have actually taken examinations on these things have done, right? But today, it is amplifies the automated process. Again, automation of vulnerability testing is nothing new. It has been in the industry for quite some time. What possibly is new from a discussion perspective is today it is those automations are more driven through a AI based logic than not. So this is very important for us to from an understanding perspective. Again, vendor TPRM, right? As I said, you'll have to probably optimize by not creating something new in your assessments, but your existing assessments, whether you can include or add your AI governance assessments, let's say, as they are available. Today, there are checklists that are available. Even the ISO 27001 2022, which has now been very conveniently categorized into 4 distinct categories, allow you the statement of applicability still continues. So it is not as if there is one size fits all. You can cut it to the size that will fit to your objective. So what do the regulators want us to do? Harm to people, privacy, right? Your use of artificial intelligence cannot take you to a level where you can say, sorry, boss, my AI tool, sort of spilled your data, and therefore I know everything about Mr. Rajnikant. No, that's not allowed. Harm to people, harm to organization. Today we see plenty of stories about these things, but that's because of more of unethical practices than ethical. And harm to ecosystem. Whether your use of something or not using something can contribute to a ecosystem falling back, and so on and so on. This is from the 101, which is almost now 1.5 years, almost 2 years old now, right? So regulators' expectation, to conclude my little presentation, for this opportunity so graciously given, I think the 45 CROs meeting in CAFRAL in CAB Pune, is a great indicator of what the regulators would want, the risk management embedding, into every process, and every process that is already dependent or being driven or completely driven by AI also be reflected in the risk management presentation, right? So we need to bring, the regulators have gone ahead. I can tell you something personal in my experience with the regulatory framework. When I was working in India, the last interaction that I had before I left India in 2003, the regulatory point of arrival on technology was fairly normal according to those times, right? The board used to ask us when we present something to the board saying, are you sure everything is all right? We used to say, yes, sir, I think I'm sure. And board used to give approvals. This sort of normal practices existed. Today, the levels of technology development in regulators, particularly I am impressed with the RBI. The RBI technology and their ability to understand technological nuances is amazing. Unless the regulated entities, that is all the banks, NBFCs, all of us here on the other side, we pull up our socks and come to speed, there is going to be a mismatch that is not there earlier. So therefore, you will be always catching up to the regulator. One way is to at least catch up totally from knowledge side, and implementation. If you can do, your organization also will be in their books. So I have spilled over by 10 minutes. I seek your apology. And thank you for so patiently listening to my thoughts. I had discussion slides, so it was useful for me to share my thoughts. I hope some of it at least were useful to most of you. I am open to any questions anybody may have.
Thank you, sir. Thank you, Mr. Sridhar, for this excellent session and for simplifying the things. For example, this data poison. So nowadays, since we look, a lot of people go for AI for getting data sets and all. So now that is a good reminder that we need to cross-check the things. And I think the SLM model you told, that would be more interesting, because we need to search authentic sites for where we are getting data. Otherwise, it will be if we blankly follow the whole data set, then the whole study may go wrong. So thanks a lot for the session, and I would like request participants, if you have any questions, you can unmute and ask the question.
So, this is Gurmeet here. Wanted to check
Yes,
up,
Mr. Guru.
is it possible to have the presentation of Cephral seminar at Pune?
I think that you will not ask Kefral, sir. I thought you
Okay,
would ask, can we have a RMA presentation? This we can share with you, but that
okay,
is Kefral property.
okay, okay. And sir, one more question. Yes, uh, okay, sorry. Carry on.
No problem. I say कीजिए आप. Whenever you are able to, sort of structure your query with
Yeah,
Mr. Dr. Rakesh's permission, you can send me an email.
right,
Or
sir.
if you are on LinkedIn, I am on LinkedIn. It will be
Okay, sir.
wonderful to be LinkedIn with all of you with whom I am not LinkedIn. I can see Pooja Beti here. Pooja ji, how are you? How's your, people like that. I know a lot of them are already on LinkedIn with me. Some
Okay.
of you who are not, you can put it on LinkedIn chat box also. That is also a wonderful tool of communication.
So I am doing a project basically on risk management framework with respect to the pharmaceutical industry. And
Okay.
I have made a questionnaire which I am sharing with the pharmaceutical companies, and it is difficult to get a response because the subject is such. Is it possible to use your good offices to get some of the responses? If I can share my questionnaire with you.
Well, you please share the questionnaire with me. It will help me learn. But I will tell you one thing. I am in probably not even in the proximity you are to the industry. I would
Okay.
recommend from just for I told you in the beginning, avuncular status. I would recommend you go through an industry body, particularly related to their industry. It would
Okay.
then probably have greater traction.
Right, sir.
But it will be very interesting to see your question whenever you can share with that, or when you can make it open source. I'll be definitely
I will do it, sir. I'll do it.
Thank you. Thank
And
you.
sir,
Thank you.
one
I'll
more
wish you.
thing.
Yeah.
What does the name L Pattabhiraman rings a bell?
Pattabhiraman rings a bell, but M or L?
L Pattabhiraman.
Oh, yes. Oh, yes. We state bankers, very
Yeah.
clannish.
We were batchmates. I was batchmate with him at BITS Pilani.
Oh, I thought in State Bank, so I was a
No.
bit surprised, but oh, very good. Very, very good. No, LP is a fairly popular guy, though I think he's, I don't know whether he's 2 batches or 3 batches junior.
I think he joined in
in these
81.
services. Huh?
I think he joined as PO SBI in 1981.
81, then he's 1 batch junior to me.
Yeah, 1 batch.
I'm 80. I belong to the 80 batch.
Right, sir. Thank you.
Okay.
Thank you. Thank
Can
you.
we have next question from anyone? Mr. Swapnil, Mr. Mayank, I think you had some questions in the chat box.
Yeah, hi, this is Vijayanand Subramaniam. Can I?
Yes, sir.
Okay. I mean, a couple of these sectors are definitely driven by regulators. I mean, you've got RBI, IRDAI, and SEBI. So these participants are definitely taken care of because they're quite stringent in terms of being in the financial sector. Now, what about other sectors which are not regulatory driven? Because that's where
Wow.
the problem
Show me
comes.
one. Mr. Vidyanand, show me one
Yes.
that is not regulated.
Sir, manufacturing sector, you take
Oh,
specific
yes,
to
they are wholly very, very heavily regulated, sir, depending on what industry you're talking about. Manufacturing is a very large umbrella term.
correct. So, for example, if you take the textile sector,
Oh, yes.
So-
Yeah, go ahead, sir. Go ahead.
yeah, so if you take the textile sector, so definitely even a lot of automations are going on today. Now, even in case of operational technologies being in couple of sectors, which is being used, there, of course, I mean, sensitization and awareness is definitely not to the extent that is there in financial sector. So there is no, I mean, I don't know if you said there is everywhere it is regulated, but I somehow feel that regulation doesn't really come into play with respect to all these sectors. Even if
Yeah,
you
I
take,
think one.
Yeah.
Yeah, please go ahead. I'm sorry to interrupt. Yeah.
so for example, similarly to other manufacturing sectors also, I mean, textile is just one I have taken up, but even if you take other production centers, wherever, for example, pigment, chemicals, in all these areas, Some, of course, are domestic, and some, of course, have international connections. In
Yeah,
all
yeah.
these cases, also, still we believe that the cyber resilience is far, far away. I mean,
No,
I do
that
not
the
see
last
the,
statement of yours is very, very true. It's a universal statement now. We
and
are
I,
far, far behind the curve. There is no doubt
correct,
about it.
and I do not see the regulatory intervention so much as it is happening in financial sector.
That is true. That I agree with you. It is actually a feather in the cap of the financial institution regulators. That is certainly without a doubt. I mentioned that in my concluding remarks also. Without any doubt, they have leaps and bounds. I mean, exponential growth or explosion in their knowledge levels, perception levels of how they manage technology related issues for the entities that they regulate, without any doubt. And probably, as you say, from the experience, on a relative term, they are far ahead of the other regulators also. And in taking just textiles to be a touch point, as a banker, we guys lend regularly to all sorts of fellows, right? So therefore, our touch points are more from our borrowers, learning from that and all that. If you are, I don't know, whether are you based out of Coimbatore, sir, if I can ask?
I'm in Chennai, sir.
You are in Chennai. For example, if you look at Coimbatore as a, at least past glory, Coimbatore has got enough of self-regulatory organizations, which are a proxy to the regulator. That's all. They take care of more than going and representing towards for budgetary allocation, budgetary proposal amendments to various tariff and other things, because there the regulation is not only in the technology but also in the product. Which product, who can produce? See, for example, except for the small finance banks not being allowed to lend to, let's say, an Adani project, right, directly, there are no product wise limitation from a regulatory perspective for banking products, right? You may have to take certain product clearances if you want to introduce insurance product along with a deposit product, something like that, right? But whereas if you go to the non-financial sector at the product level, like what is reserved for a handloom, sector cannot be manufactured in a machine loom and stuff like that. You know that better. We guys have seen it from outside. So there, when you adopt technology like that, and when the technology probably, let's say earlier, the jackards used to be punched, right? When for your design. I know where jacquard punching itself was supposed to be an art, very specialized resource. Today, you simply, what do you call, download the graphic, interface graphic to your CNC, and it is already producing before you know. So, therefore, when you are talking about that level of intervention, even the OT, your SCADA alone and other requirements alone will not be enough. So, therefore, the resilience part of it, as you rightly said, there is a gap from the regulator, because the regulator is still dealing with whether you are manufacturing a handloom product in your machine loom or otherwise, instead of looking at what is the technology that are driving the machine loom, or even at the design and deployment level, what they are doing. So there are issues that are coming in at the regulator level than the regulated level. So I see more of an aspirational problem in your statement than a production problem. You would like your industry, for example, to be high level. Paint, you mentioned. Paint, from a little I know, the type of chemicals they can use. People not following that is a different issue. The type of chemicals that can be used to blend a particular type of color. Asian paints, all of us know, bringing about the choice of color at the delivery point, where they kept a machine at the hardware store where you can combine more than one color to produce what you want. But the problem with that is, that created environmental problems, spray and stuff like that, that they have to now relook at the entire design. So therefore, on one point, what can be done is stipulated, regulated. On the other point, how do you use that regulation to go expand your product, create that USP, create that uniqueness, uniqueness for your delivery system in an otherwise almost homogenic industry. It's more stifling. And therefore, these challenges possibly are the reasons. And the government still has, for example, most of your quality control. I don't know how many of you have actually visited that organization in Jaipur. And when you go to quality control institute, you find the academic guy standing 10 feet tall and the procedure guy somewhere lost in the bushes. So therefore, this is again part of the entire bureaucracy. And we are living with that. Things are getting better. I have told you from my own personal experience, and I wish it happens everywhere. When I left India, the last RBI audit I had was 2003 when I was in Standard Chartered Bank. And I know what interactions went on there. And the last consulting that related to our audit happened sometime in 2020 sort of thing. So in these 17 years, I know what had been the development, what had been the difference, what have been the profile, difference in the profile of the technology related audit and assurance providers at the regulatory level, how it changed. If you read some of the circulars now, you know, they are beautiful manifests. You know, for the uninitiated, they can learn a lot. So to this level of expertise has been groomed or has come in or whatever they have done. I wish to believe that they groomed it, particularly after Gopal Krishna committee report and all that.
Yeah.
RBI itself probably would have done its own gap assessment. So every regulator needs to do that. If we can contribute to that through our industry bodies, RMAI, you can, you know, join Dr. Rakesh Agarwal and all the others who are dealing with textile industry. Dr. Rakesh Agarwal, I don't know how many of you know. Apart from his other life, he is also a qualified chartered accountant, and he does a lot of work on, you know, the financial statement assurances. So he would have extensive contacts on both sides. So probably he and his directions would be very useful for your, you know, industry body and so on and so forth. So these are, you know, going to take, okay, what is UCL, LCL, upper control limit, and I hope I answered at least some of your points, Vijayanand.
Yeah, definitely, sir. Sir, I just want to extend one more question to that. Now,
Yeah, please.
I'm just coming back to the financial services itself. Now,
Okay.
RBI definitely has laid down these guidelines, regulations, and all for cybersecurity and other stuffs, including, I mean, AI also, you know, is going to step in much deeper, I would say. Now, with respect to the portfolio that the banks maintain, now has RBI really gone into the credit portfolio or the assets of the bank, which are nothing but their own customers or the clients, where they are put at risk because of cyber? Has RBI really taken that into account is a question that I have.
Oh, very good. You see, I will only use an analogy outside of banking, but probably from our personal life, right? Your parents, when you're young, you know, you seem to be a young man anyway, but when you're much younger, you know, probably in your teens, when you go out on probably a trip, you know, a trip along with the overnight, you know, stay and all that, your parents would have given you the resources and also a large dose of advice saying, you know, do this, don't do this. Now, it is very difficult for them to go expect to do a complete resource study at the other end before they send the child. That normally, you know, as a growing parent, you would know. It doesn't happen. And even if it happens, it probably would look a bit overkill. The analogy here is RBI can only ask you to do so many things. If all of us, all the banks in India, let us say, like a military unit, right, fell in line with the RBI, there won't be any difference between which bank you went. So the uniqueness comes in from their own banking practices, thinking, or their own understanding of what the guidelines mean to them. So this uniqueness or idiosyncrasy is always going to exist. And it is for you to manage that as a business. Some of us try to manage it well, some of us manage it well.
Thank you, sir. Thank you so much. And thanks for responding to my questions.
Yeah,
Thank you.
Mr. Sridhar, can
thank
you
you.
stop the screen sharing? So can we have one-to-one?
Oh, yeah. Sorry. Yeah. All right. I'm sorry, sir. Yeah. Again, process flaw.
Yeah.
Mr. Gurmeet Singh asked UCL, LCL. Sir, it is a statistical representation. Any estimate is only an estimate. You want an objective, you want an output that should be, let's say, at 97%. That is at that point of when your objective setting, it is an estimate. Statistically, an estimate is only a hypothesis. If something goes right, this you will get, you know. So you need a level of tolerance. You can have zero tolerance. For fraud, we have zero tolerance. We don't say first time fraud committing or something like that. Right? So we can have zero tolerance. But when you have tolerance, we don't have tolerance on only one side of the curve. We have both UCL and LCL. Most of us, you know, in school, we studied statistics, basic statistics, and promptly forgot it after we finished the exam. So nothing wrong. I mean, welcome to the club. That's all. So UCL, LCL is very important for most of us to understand, right? And this is where our tolerance setting, particularly for our achievements, when you do continuous monitoring, whether the tolerance setting itself is predicated on, you know, values that could be dependable or even meaningful, right? And so on and so forth, right? Just as we thought the Ukraine variable is going to come down, then some other variable cropped up somewhere else, right? And so these are not under our control. What we need to constantly keep looking at, what is the distance between the value of the two variables as it impacts your objective. That's all.
Thank you.
Mr. Mayank, are you there? You had a question, I think.
Sir, Vijayanand, I just want to come back on another question.
Yes, sir. Please do.
Okay. Now, sir, given that the DPDP law is in place, I mean, which also would closely relate to these things because privacy would also be a key factor. Now, what is the deterrent, I mean, for the market? Because see, I mean, hacks are happening, data is moving out, but you still do not see, it as a big deterrent in market. There should be some fear, right? I mean, how are you going to implement a law unless it becomes a deterrent for someone? So, for example, let's say the recent Star Health Insurance case. I mean, that's a big one, actually. It's a massive one. I mean, in the Indian context. Now, it's still under investigation, definitely. I mean, it would take some time to come out actually with what happened and who is the right culprit. But given the precedence of cases which has happened last year with respect to Sun Pharma, with respect to granules and couple of other things, how is the regulator going or the law going to look at it, in the next coming years, by which we can say that, yes, this will be viewed very seriously and corporates have to really act on it?
Very good. Are you? Can I take your questions over, sir?
Yes, sir. Yes.
See, the DPDP Act itself. The DPDP Act itself is an output of certain cases, like you mentioned. The Star Insurance case is very topical, right? And immediate reaction of IRDA also has become probably on the expected lines. The cybersecurity guidelines for the insurance industry, it is not as if it was not there, is now going to become more stringent. That's all. See, we learn. That is what a learning model is supposed to do. What went wrong? How do you rectify it to prevent it? So we have these concepts probably at a lower level of manifestation even from our traditional kappa. When we had a problem, what did you do with the problem? You did a corrective action to immediately correct or rectify the situation, and you also simultaneously planned a preventive action so that the same mistake doesn't occur again, right? So therefore preventive actions could be long-term, long-drawn, action plan dependent, resources dependent, and all that. Corrective action could be a band-aid, and therefore it would only have that resolution of what a band-aid can do for an immediate problem. The problem might be much larger than the band-aid, but at least it clogged, it stopped your missing. So the objective for a CA and a PA has not changed. Only thing, the deployment, the dimensions are changing today in the examples, later day examples that you spoke about, right? And the means of managing it. Technology is an enabler. Technology, as we all know, we repeatedly have to, remind ourselves of this. What I always say is the Sachin Tendulkar, quote: irrespective of what your score is, right? You have to take your off-stick guard. So that means you cannot relax. You cannot relax because you have input your CA. You will have to continuously see whether that CA is still relevant, even when the PA is running parallelly. Probably it has got a time bound, whatever it has got, right? And so on and so forth. I don't know. It would be very, you can't sort of straitjacket it. It will be very, very idiosyncratic. What I'm trying to tell you here is the urgency or the anxiety that seems to come out in the type of your question is actually predicated on, a need to prevent this completely than anything else. It is not even accusatory. Saying, why the hell, I mean, if you want, sorry for the language, why the hell can't we stop something like that? As you know, it is only now India is becoming, see, one of the biggest problems in our projecting ourselves as Vishwaguru is, you become a mango tree full of fruits. So you will get your share of stones, right? So you see, if you look at the number of incidents that are happening at other advanced, economies, and you want to be in the top 5 or you are already claiming you're in the top 5 or top 3 in purchase parity and all that, you are going to get your share of stones in the form of this thing. Somebody is going to think your Star Health Insurance, profile is very, very high. Why? Because he is also in his artificial intelligence tool enabled search, he is also saying is only 1.9% of the Indian tax-paying community have health insurance cover. So obviously for that guy, this particular piece or any information of this level should tell him, so this is cream de la cream, so let's go hack this guy. So you see, so suddenly the data was already there, the hacker's capability was there, but suddenly now the threat model has brought you into his threat focus because of these variables working in. So that is the lesson we need to understand as from a risk management perspective. And therefore, then what do? Do we underplay ourselves? Yes, if your marketing and your overall strategy will allow that. If that is going to work, very good. If that cannot work, one of the reasons why you hear very little of State Bank being attacked is they have the largest database. 26% of all banking is with the State Bank of India in terms of sheer volume. So whatever you hack out of State Bank, I'm not recommending that. 26% of that will have to be almost representative of the whole. But yet why it is not happening? Because, this profile as a contributor, as a variable probably is missing between him and let us say, a Citibank or a Standard Chartered Bank and all. So therefore, sometimes what we think is a strength, if you did a profile study, you would probably place Standard Chartered higher than State Bank of India. And that itself is a threat contributor today. So these are variables that are coming in as we are understanding. These have to be now validated with further data. That means we'll have to wait for some more people to die. So you see, there are many downsides to this, but it becomes interesting as a study, as a student of risk management. Because what we manage as risk, when, there are a couple of my batchmates, I can see the names here. When we started banking, right, there was, data was what was on your ledgers. When I went into information security, all data had to be secured. Today we are talking about DPDP Act. And DPDP Act is for, in India, it is very, very clearly only on personal information. That means, can I go talk about EID Parry and their details to somebody? Certainly not. So it is nothing to do with DPDP Act. It is more to do with my self-governing. So this is what is an evolution, sir. It will come. You youngsters like you will contribute more to this industry. You will develop the patience. We all also were, happy at one point in time. We then mellowed down. And today we are able to share those experiences with you. I'm sure you will be able to share greater value. I wish you all the very best. And if there are any other questions, I would say for interest of time, because some of you have come and logged in at 3:30 itself. Yeah, any questions, sir?
Yeah, so we'll be just closing within 5 minutes. So if anybody has any question left, Mr. Sandeep, Mr. Mayank, I think you are not able to speak, I believe. He had one
Sir,
question.
they can send me
they
can send emails.
Yeah, sure.
So can I give my email on the chat box, sir?
Sure. I'll chat it, mention it.
Sir, you can hear me, sir. Swapnil is speaking, sir. You can hear me?
Yes, sir, I can, sir. Mr. Vyas.
Sir, I would like to know about compliance. Is there a tool is available or AI related compliance work, sir, right now, sir?
Sorry, sir. Can I understand the question better? Can you kindly expand on that?
Sir, compliance for grievance resolved for the customers, many companies is adopting this one, like financial segment, insurance and banking also. So specifically compliance for which is courts. So that is also tools available right now, sir?
Honestly, I would like to see tools like that, sir. Because so far what we are doing is we are taking the complaint as a unitary value and then looking at whether it is valid, invalid, whether it pertains to our operations or not, and responding according to that. Suppose somebody says, your interest calculation is wrong, we check our interest calculation and revert back saying apologies. So sorry, sir, ours is wrong, we are rectified. Or we respond back saying, sorry, your calculation is wrong. Whatever. That means we take the grievance redressal wherever they are at unitary value. Whereas if we are able to look at the same complaint, saying what would have triggered this man to check this thing, whether we have done similar mistakes, whether there is any comment in any social
Mr.
media
Sridhar
saying,
has lost connection.
interest. Sorry. Can you hear me, sir?
We can't
Hello?
hear you, Mr. Sridhar. Yeah. The screen was freeze, so we couldn't hear you.
Oh, okay. Can you hear me now?
Yeah, it is fine.
Yeah. What I'm saying is, if you're able to look at the connected points that could be drivers, probably he went and checked his email, interest calculation, because his friend wrote somewhere in an email saying calculation by Mr. Sridhar is wrong. So you would like to know whether there are more affected parties, there are more contributors, and therefore you can look at not just as a unitary value, but more as a systemic issues where if there are large numbers or any other process requirement and so on and so forth. So instead of becoming a linear process, things like these tools like what you mentioned, Mr. Vyas, can become more non-linear and can become contributing to many different attributes. That is all. But I don't know any tool, sir. But it is a wonderful thought. You may want to discuss with few of your friends. There is a potential product there, I think.
So I think,
Yeah, sir. Because sir, I saw in the market just one software company a seminar I also attended, in which mostly focus on the financial segment, but they are not going to specifically for the compliance right now. So I am just asking for the in respect of that only, sir.
Okay, sir. Very nice. Share some details if you have, so we also can learn from that. Thank you so much. It's a very nice question.
So thank you, everyone. I think we have run out of time of the session, so we will have to close it now. So thanks again, Mr. Sridhar, for an excellent session and explaining the things beautifully. So and thanks to all the participants for attending the session. And even today in the holiday, we have this Dussehra today. So from RMI team, we would like to wish everyone a happy Dussehra. And if you have any questions left, you can always mail it to us at info@rmaindia.org. So definitely get back to you, and we will also share the soft copy YouTube link of this particular webinar. So again, thank you everyone for attending the session, and we will again be back with another session maybe by the end of this month. So please keep a track on website of RMI. Thank you everyone for the session. Thank you.
Thank you, Dr. Rakesh. Thank you, everybody. Happy Dussehra.
Thank you, Sridhar sir, and thank you, team. Thank you.
Thank you.